Hello friends, welcome to Business Hologram YouTube channel. Today we are focusing on the company Atlanta Electricals Limited. Let's get straight into the module company overview. So Atlanta Electricals Limited is a prominent Indian manufacturer specializing in the production of power, auto and special duty transformers. Headquartered in Anand in Gujarat, the company has grown significantly since its inception in 1983, evolving from a partnership firm into a publicly traded entity as of September 2025. Uh, Now, let's look at the market presence and clientele of the company. Uh, if we analyze the customer base, we can see that the company serves a highly diversified client base across India, spanning 19 states and multiple union territories. Their customers include major public sector undertakings, state utilities, and private sector players in sectors like renewables, steel, and infrastructure. If we analyze the market position, it is recognized as one of the leading manufacturers in India by production volume, leveraging approvals from key organizations like PGCIL and the Ministry of Railways to enter new geographic and product segments. Uh, Now let's have a look at the stock price and details. Current stock price of the company stands at 1,751. Market capitalization values rupees 13,726 crore, which falls into the mid cap segment. If you look at the 52-week range of the stock price, we can see that the highest price achieved is 1,846 and lowest price touched is 707. Let's look at the core business and products of the company. The company provides a wide range of electrical equipment used across power generation, transmission, and distribution sectors, as well as by industrial end users. The product portfolio includes power transformers, inverter duty transformers, special duty transformers, and if we look at the operational capacity and infrastructure of the company, we can see that they are capable of manufacturing transformers up to 500 MVA capacity and 765 kV voltage class. If you look at the scale, following recent expansions and the acquisition of BTW Atlanta Transformers, the company's aggregate manufacturing capacity has reached approximately 63,000 MVA per annum. Now let's look at the financial performance of the company for the last 4 quarters. The data is given in the screen, as you can see. So the key takeaways from the data that is highlighted in the screen are it has exhibited strong growth. The company has demonstrated a robust upward trajectory with the December 2025 quarter showing a significant jump in both revenue and profitability compared to the previous quarters. Next point that we can derive is margin expansion. Operating profit margins have steadily improved over the last 4 quarters, climbing from 15.5% in June 2025 to nearly 20% by December 2025, reflecting better operational efficiency and pricing power. Next point is rising interest costs. While operating performance is strong, interest expenses have increased, which is a factor to monitor regarding its impact on net bottom line growth. Now let's look at the strategic initiatives of the company. Atlanta Electricals Limited is currently pursuing an aggressive growth strategy centered on capacity expansion, market diversification, and operational scaling to capture the rising demand in India's power and infrastructure sectors. So we can broadly classify the strategic initiatives of the company into 3 points. We'll discuss each point. First point is aggressive capacity expansion. So the first part that is coming in this initiative is AEL has increased its total manufacturing capacity by approximately 278% from 16,660 MVA to 63,000 MVA. Next, they are focusing on infrastructure growth. This was achieved through the commissioning of a new greenfield facility in Vadod and the strategic acquisition of a controlling stake in BTW Atlanta Transformers. Next, if we talk about the capex plan, the company is maintaining its momentum with a planned capital expenditure of approximately 260 crores for FY 2027 to further bolster operations and infrastructure. So the second major strategic initiative of the company is market diversification and export push. So they are looking for sector expansion beyond their established presence in power transmission and renewables. AEL is actively diversifying into the railway sector, focusing on traction and trackside transformer products. Next, they are focusing on global footprint. A key strategic initiative for FY27 is a targeted push into international markets, specifically prioritizing neighboring countries, Africa, the Middle East, and Europe. Next, they are heavily focusing on client acquisition. The company has successfully grown into client base from 77 in FY 2022 to 251 by Q3 FY 2026, maintaining a mix of major PSUs and private sector players. So the third major strategic initiative of the company is technological and operational focus. They are focusing on high value capabilities. The recent expansions enable the production of transformers up to 765 kV, allowing AEL to enter high value segments that were previously inaccessible. Next, they are focusing on operational discipline. Management is prioritizing cost efficiency measures and supply chain optimization to protect margins as they scale. Next, they are focusing on working capital management. A significant portion of funds from their recent IPO has been earmarked to support working capital requirements, ensuring the company can handle larger, more complex and project life cycle. Now let's look at the ownership structure of the company. The data is given in the screen. As you can see, the promoters hold 87% of the shares. Retail and other investors hold 6%. Mutual funds 3.55, foreign institutional investors 2.4, and domestic institutional investors less than 1%. So key insights from the data that we get is promoter stability. The promoter holding has remained steady at 87% since mid 2025, indicating strong confidence and stable control by the founding management. The core promoters include Niral Krupesh Bhai Patel, Amesh Krupesh Bhai Patel, and Tanmay Surendra Bhai Patel, alongside various trusts and corporate entities. Next key insight from the data is institutional participation. While the promoter stake is dominant, there has been a gradual increase in participation from mutual funds and FIIs over the last year, suggesting growing interest from the professional investment community. Next key insight that we get is low free float. Due to the high promoter concentration, the free float is relatively limited, which can sometimes lead to higher volatility in the stock price during significant market movements. Now let's move to the financial ratio analysis part. First, we will be focusing on the profitability ratios. So as you can see in the screen, first on the return on equity parameters, the company's value stands at 40.8, where the industry average is just 15 to 20%. So it has a exceptionally high value in this parameters, reflects superior shareholder value and creation. Next is return on capital employed. The company's value stands at 39.4 to 49.8, where the industry average is 18 to 22. So in this parameter also, the value of the company is significantly higher than when compared to the industry peers. So that is a positive sign for the company. And when we look at the operating profit margin, we can see the company's value stands at 19.4, where the industry average is 12 to 15. So that also indicates strong control and operational discipline. Next is net profit margin. The company's value stands at 9.5%, where the industry average is 8 to 10%. So that is mostly aligned with the industry average. Now let's look at the leverage ratios of the company. First, we will consider the debt to equity ratio. The company's value stands at 0.21 to 0.33, where the industry average is 0.5 to 0.8. So the value is very low, indicates strong unleveraged balance sheet, which is a positive sign for the company. Next ratio we are considering is interest coverage ratio. The company's value stands greater than 5, and where the industry average is 2.5 to 4. So in this parameter is also the company is having a strong foothold. It has high ability to serve debt obligations from operating profits. Now let's look at the valuation ratios of the company. First ratio is price to sales ratio. The company's value stands at 3.78, where the industry average is 2 to 3. The firm is trading at a bit higher value, which reflects market premium for growth potential. So the investors are mostly seeing a growth potential in the company. so the value justifies that. Next is price to earnings ratio. The company is selling at a price to earnings ratio of 90 to 96, where the industry average is 30 to 65. So the value is significantly high, implies high growth expectations from the part of the investors. Next, if you look at the price to book value, we can see that the company's value stands at 17 to 18, where the industry average is 5 to 10. Assets are valued at high multiples due to scale. So in the valuation ratios, the company is mostly at a higher side, or it is attracting a premium valuation from the part of the investors. Now let's move to the SWOT analysis of the company. First, we will focus on the strengths of the company. First point is operational scale. Recent massive capacity expansion to 63,000 MVA has solidified its position as a top-tier manufacturer, crucial for fulfilling large-scale infrastructure orders, which is a prime strength of the company. And next strength point that we are considering is superior capital efficiency. Elite ROE and ROCE highlight exceptional management of capital, setting it apart from broader industry peers. Next is robust financial discipline. Minimal debt to equity ratio in the range of 0.21 to 0.33 provides a strong safety buffer during market volatility. Next, we will analyze some of the weaknesses of the company. First weakness that we have identified is concentration risk. High dependence on the domestic Indian market, that is PSU, state utilities, for the bulk of its order book and revenue. Next point is market overextension. Trading at high PE multiples creates significant pressure to consistently beat earnings growth expectations. Next is working capital intensity. Heavy reliance on project-based cash flows can create liquidity bottlenecks, as seen in recent trading pressure. Next, we will analyze some of the opportunities in front of the company. First point that we are considering is grid modernization. India's aggressive pivot to renewable energy and transmission upgrades ensures a long-term demand pipeline. Next point is higher value segments. Successful penetration into 400 kV, 765 kV transformers and railway-specific equipments open higher margin revenue streams. Next point is international market entry. Diversifying into African and Middle Eastern markets can reduce reliance on domestic tender cycles. Now let's see some of the anticipated threats in front of the company. First point is raw material exposure. Profitability remains inherently vulnerable to price fluctuations in key commodities like copper, aluminum and steel. So the next point is valuation correction. As seen in recent sessions, premium valuations make the stock susceptible to sharp corrections. Next point is competitive landscape. Increasing competition from established power giants and nimble low-cost entrants in the mid-cap space. So friends, that's all about a short company and stock analysis of Atlanta Electricals Limited. I will come up with a new company for the analysis session in the next video. If you have found the video useful, please like, subscribe, comment, share and support. Thank you.